Yes, sir.
Okay. So as I was mentioning before this technical hiccup, this particular related party transactions have assumed the centerpiece of this regulations 2015. And over a period of time, it has acquired certain dimensions which were never originally envisaged. Additionally, the recent amendments to this LODR, of which there have been some, in my view, a sort of a pushback based on the press conference held by the chairperson SEBI in this week, that they would attempt to have a standard setting procedure by the industry bodies and professional bodies in terms of most of the clauses introduced. Nevertheless, I've also got into made this LODR extremely relevant and also complex as far as professionals are concerned. It is something. Yeah, what is this? So it is almost become so important. It has become so much important that any amount of deliberations on the subject will still leave many things unsaid and unlearned. And to that extent, we had a webinar on 1st of July, Savitri Parikh, where she talked of this regulations of the LODR amendments. And now we are again meeting today to talk of specifically about Regulation 30, which is connected with the disclosure, transparency, and accountability. And this is directly affecting the profession of company secretaries because they are the compliance officers. And to that extent, their understanding and knowledge of the subject is extremely critical and crucial, not only to the corporate governance in general, to the practice of corporate governance in general, but in my humble view, even in terms of the professional competence, which we are all used to. In that context, we thought it fit to have the second webinar on the same subject in this month. And we felt that we should have somebody who has got enormous exposure and experience on the subject and many others, Mr. Manoj Bantia. Manoj Bantia is a practicing company secretary from Calcutta. And our association goes back to almost 2 decades now. And like so many others, every time I hear Mr. Manoj Bantia, I feel amazed at the sweep and the reach and the range of his expressions, and also the depth and the understanding he brings to the topic. May I now request our colleague Sucheta Tamane to officially introduce Manoj Bantia.
Good morning, everyone. Sucheta Tamane here. It gives me immense pleasure to introduce our speaker today, Mr. Manoj Kumar Bhatia. Mr. Manoj Kumar Bhatia is an associate member of the Institute of Company Secretaries of India and a fellow member of the Institute of Chartered Accountants of India. He has also been the past chairman of the Institute of Company Secretaries of India, Eastern India Regional Council. He is the managing partner of MKB and Associates, practicing company secretaries. He has the experience of practicing in the field of corporate laws for around 30 years. Mr. Bhatia is the secretarial auditor of numerous reputed listed companies and has also been engaged as a retainer for providing consultancy services to them on various matters related to corporate laws and allied laws. His core areas of practice include corporate litigation, insolvency and bankruptcy code. He has appeared several times before the NCLT, NCLAT and the regional director, corporate restructuring, compounding of offenses, secretarial audit, providing advisory and consultancy services in the field of corporate laws and SEBI related laws. Mr. Bhatia is also a trainer and a regular speaker at training programs and seminars on various subjects in the areas of corporate laws, corporate restructuring, etc. conducted by ICAI and ICSI. He also conducts classes for professionals on such subjects. He has also trained officers of Ministry of Corporate Affairs and the Comptroller and Auditor General of India. Please welcome Mr. Manoj Kumar Bhatia. Over to you, sir.
Thank you very much. I hope you've allowed me to share the screen, right?
Yes, sir. Are you able to share your screen, sir? Yeah.
Is everybody able
Yeah,
to
we
see
can
that?
see your screen, sir.
Is it full or is it partial? Is the view full?
Yeah.
Yeah. Good morning and thank you, Anand Subramanian Saab, for inviting me to be a speaker at today's webinar on related party transactions and Regulation 30. At times, I feel that having spoken so much about related party transactions, I feel that perhaps Companies Act and SEBI laws are the only places where relations are not valued much and people like to hide relations more than flaunt it. Related parties are best kept hidden. Related party transactions are best kept undisclosed. Related party transactions perhaps have the major impact on the securities prices and the values of companies to which they relate. As far as the investor is concerned, a related party transaction is an alarm bell. As far as a promoter is concerned, a related party transaction may be a necessity sometimes to protect the patents or trademarks that they have, and sometimes to overcome certain regulations. Each stakeholder has his own wish list to undertake such related party transactions. But as far as the regulator is concerned, they have a very clear vision that these transactions have to be disclosed. Full transparency has to be maintained with respect to these transactions. The laws have to be completely complied with while undertaking these transactions. The information relating to these transactions have to be provided to shareholders and to other stakeholders in the manner that they are able to understand the impact of these transactions and are able to judge whether they need to remain invested in such companies or whether they need to take a decision with respect to their investments in these companies. So important are related party transactions, but the law relating to it seems to be so complicated that decoding a related party transaction becomes every professional's nightmare. We are kept wondering, who is a related party? What is a related party transaction? When I enter into a transaction with a particular entity, whether such entering of transaction would fall within the ambit of related party transactions? Is the related party with whom I am entering into transaction has to be my related party? Or even if it is my associates related party, do I need to disclose? Is my status as a particular company, I am a private company, I am a public company above certain thresholds, I am a public company below certain thresholds, I am a listed company but below certain thresholds, I am a listed company on the main board. Are the compliances same for all of us? Depending on my status, what laws do I need to comply with? Is it only one particular section of the Companies Act? Is it one or more sections of the Companies Act? Is it also the LODR that I need to comply with? Do I also need to look at the accounting standards? What is the difference when I am disclosing related party transactions in financial statements and when I am making compliances with respect to entering of related party transactions? And what if there is a default in making the compliances as required under the relevant laws? All these questions keep us wondering. And all these questions have to be understood, have to be meticulously and diligently complied with so that you don't falter when you are complying with provisions relating to related party transactions. The first question that needs to be answered is, who is a related party? I mean, do I only have to look at the Companies Act? Does the SEBI LODR provide any definition of related party? Is the related party relationships as provided in the accounting standards, are they relevant to understand, to decide who is a related party? Is there only one accounting standard that I need to look at in AS 24, or whether AS 18 is still relevant to decide whether a particular entity is a related party or not? Does the definition of related party as given in section 5 subsection 24 of the Insolvency and Bankruptcy Code, does it have any relevance as far as compliance of related party transactions are concerned? All these questions have to be carefully understood to really decide who is a related party. When you look at the Companies Act, we all have seen section 2 subsection 76 several times. And we all know what section 2 subsection 76, who subsection 2 subsection 76 defines as a related party. But is this definition of related party as given in section 2 subsection 76 the only definition that is relevant to decide compliances in respect of transactions with a related party? The first point that one needs to understand is that disclosure of related party transactions in the financial statements is in accordance with accounting standards applicable to a particular company. Those disclosures may or may not match with the compliance requirement with respect to related party transactions. Disclosure requirements are separate and compliance requirements will be separate. Disclosure requirements are totally governed by the accounting standards. Disclosure in the financial statements are totally governed by the accounting standards and the manner in which accounting standards require disclosure of such information. Whereas compliances with respect to a related party transaction is to be understood in the context of the Companies Act. And if you happen to be a listed entity, then also in the context of LODR. A related party as per the accounting standards may not be a related party as defined in section 2 subsection 76 of the Companies Act. A private company which has only directorship in common, where you have only one director in common, may be a related party as far as section 2 subsection 76 is concerned, but commonality of a directorship may not necessarily lead to disclosures, may not necessarily lead to a particular entity becoming your related party under the accounting standards. Neither AS 18 nor Ind AS 24 consider such private companies where there is a mere commonality of directorship as a related party. So you have to first understand who is a related party under section 2 subsection 76. And if you happen to be a specific company, say a listed entity, then this definition has to be expanded, keeping in view the provisions of the related party relationships as defined in the applicable accounting standard. If you are not a listed entity, then section 2 subsection 76 definition of related party is the only relevant definition to decide who a related party is. I mean, I'll quickly run through this. A director or his relative is a related party. A KMP or his relative is a related party. A firm in which director or relative is a partner is a related party. Private company where there is a commonality of directorship, or even when one of your director happens to be a member, then it is a related party. Public company, there is necessarily a requirement of commonality of directorship plus 2% shareholding to decide whether a particular public company is your related party or not. Then you have a very subjective requirement of any body corporate whose managing director or board or manager is accustomed to act in accordance with the advice, instructions, or directions of a director or managing director of the other entity. This is a very subjective thing. This will depend on the factual matrix of each and every case. And one has to objectively decide based on the facts of a particular case whether it can be said that the board of directors or managing director or manager of a particular body corporate is accustomed to act as per the instructions, directions, or advice of one or more director of the of the other company. On this one particular clause alone, we can deliberate for hours together to decide whether a particular body corporate under different circumstances is a related party or not. Similarly, any person on whose advice, instructions, or directions a director or manager is accustomed to act. If you remember the definition of the term promoter as given in Companies Act 2013, you will know that this person which they are talking about is a promoter of the company. A holding company is a related party, a subsidiary is a related party, associate is a related party, fellow subsidiary is your related party. Your investing company, what do you mean by an investing company? If you happen to hold 20% shares of, say 25% shares of a company B, if company A happens to hold 25% shares of company B becomes an associate of company A. But as far as company A is concerned to company B, company A is not an associate of company B, but company A is an investing company of company B. So your significant shareholder who has invested 20% or more in your company becomes your invested company. Only a shareholder who is a company, if he has invested more than 20% in you, then he becomes your related party because it is an invested company. But if it is an individual who has invested more than 20% in you, in none of these clauses does he become a related party unless he happens to be a person on whose advice, instructions, or direction our director or manager of a company is accustomed to that. So your significant non-corporate shareholder is not your related party, but your significant corporate shareholder is your related party under section 2 subsection 76. Now, this whole clause, holding, subsidiary, associate, fellow subsidiary, it doesn't apply to a private limited company. In case of a private limited company, by virtue of an exemption that came in 2015, this particular clause is not applicable, which means a holding company of a private company is not its related party, a subsidiary is not its related party, an associate is not its related party. A private company can enter into transactions with these entities without complying with the requirements of section 2 subsection 76, read with section 188 or any other applicable section. Because these are not related parties by virtue of that exemption notification. Similarly, a director or KMP of your holding company or their relatives are also your related parties. It's an extended definition. Not only your directors of the company in which you are associated, but even directors of the companies of your holding company or KMPs of your holding companies and even their relatives, they are also your related parties. So section 2 subsection 76, we have seen it, I mean, almost for 10 years now, and we know what does this section mean. We don't have to deliberate much on them, but only some 1 or 2 issues that you need to really take note of is that a significant non-individual, non-corporate shareholder is not a related party under section 2 subsection 76. Similarly, LLP is missing. A limited liability partnership does not seem to fall under any of these clauses. A limited liability partnership is not a firm. In fact, the LLP Act clearly says that it's not a firm under the Partnership Act. It is a body corporate. And when you look at the body corporate, the relevant clauses which are applicable to bodies corporate, there they talk of directorships. An LLP doesn't have a managing director or a director. It only has partners. It doesn't have a board. So even after 10 years, we are not clear whether an LLP would fall under any of these particular clauses. And we know for sure that a non-corporate significant shareholder is not a related party as far as the Companies Act is concerned. But if you happen to be a listed entity, then the definition of related party gets slightly expanded. And here, a related party means a related party not only as defined under section 2 subsection 76 of the Companies Act, but it also encompasses all related party relationships which are provided under the applicable accounting standards. And as on date, to all listed listed entities, in the AS 24 is the applicable accounting standard. So for listed entities, related party means related parties as defined in section 2 subsection 76 plus all those related party relationships which are provided in the AS 24. So if you are a company secretary, you cannot remain complacent and say Ind AS is not my area of work. I am not supposed to know what Ind AS says. Because you are responsible for compliances, you also need to understand what are the related party relationships that are provided in Ind AS. If you happen to be a director of a company, even then you need to know who your related parties are, though you may not be technically competent to understand accounting standards. While definitions as provided in these two legal provisions are there, the LODR further provides certain related party relationships as deemed related party relationships, irrespective of whether they are covered by section 2 subsection 76 or not, or whether they are covered by the accounting standards are. So the LODR says that any person who belongs to the promoter or promoter group is a related party, irrespective of his shareholding. Similarly, any person or any entity who is holding 10% or more in a particular company will be its related party. So a significant shareholder who is holding more than 10%, even 20% in case of corporate shareholder is also not necessary. It doesn't have to be your investing company. So long as any shareholder is holding more than 10% in your company, such shareholder becomes your related party. So wide is the canvas. Your director is your related party, your KMP is your related party, your any shareholder who is holding more than 10% shares in your company is your related party, your promoter or any person belonging to the promoter or promoter group is your related party, your holding company, your associate company, your investing company, your joint venture company, all your fellow subsidiary, they are all your related parties. And apart from that, the certain private companies as per section 2 subsection 76 or as per and certain public companies again as per section 2 subsection 76, they are also your related parties. And then based on a factual matrix of a particular case, if your board of directors happen to be controlling the board of directors of some other company, then even those, or if any of your director happens to be giving directions and instructions to the board of any other company, then that other company also becomes your related party, or that other entity also becomes your. So as far as deemed related parties are concerned, we are very clear that anybody who is a part of the promoter or promoter group, or anybody holding more than 10% shareholding in the entity is a related party. As far as section 2 subsection 76 is concerned, we have seen who are those specific persons who are our related parties. Now we need to understand who is a related party under Ind AS 24. Ind AS 24 says that any person or a close member of that person, if he happens to exercise control or joint control over any reporting entity, then he is a related party to that reporting entity. Control means holding more than 50%. In quantitatively, control means holding in a position to hold more than 50% of the voting rights in that particular reporting entity. If any person or a close member of that particular person is in a position to exercise significant influence over a reporting entity, then that person also becomes a related party. Now, if you look at the deeming provision, it talks of only 10%. Significant influence talks of 20%. So by the deeming provision, anybody who is holding more than 10% would become a related party. And as far as Ind AS 24 is concerned, you should be exercising significant influence, which would mean 20%. But the deeming provision, by virtue of your holding 10% itself, considers you to be a related party. Similarly, if you happen to be a KMP of a reporting entity or its parent, you become a related party to that particular entity. Now, they don't use the term relative, they use the term close member. While the definition of the term close member happens to be more or less similar to the definition of the term relative as given in the Companies Act, but with certain additions. Of course, your spouse or domestic partner. A new concept of domestic partner has been introduced. Your brother, sister, father, mother, your children. Children of your spouse or domestic partner. Children of your spouse or domestic partner does not necessarily be, suppose you are married to a person who has been married before. And if that person has some other children from the previous marriage, then those children also become your related parties. They also become close member, and being close member, they are covered by Ind AS 24. So while the definition of the term relative is more or less similar, but we have some bit of expansion in Ind AS 24, bringing in certain new concepts. Similarly, as far as this particular part is concerned, it talks of individuals. It doesn't talk of a relationship between entities to decide whether a particular entity is your related party or not. Thereafter, Ind AS 24 says that all these relationships will also be considered as related party relationships. I am a company, and me and if some other company happens to be a part of the same group, now the concept of group has come in. I am an entity. I am an associate of one particular entity, and that other entity has a joint venture. Whether that joint venture and me are we related parties? There is a company A. The company A has two joint ventures, AX, AY. Whether AX and AY are related parties? I am an associate of, say, Tatas. And then the Tatas also have another joint venture. Whether this joint venture and associate, are they related parties? Mr. X is controlling me, and Mr. X is controlling 20 other companies. Whether those 20 other companies inter se, are they related parties? Mr. X has significant influence over me, which means he's holding more than 20% in me. And Mr. X is a KMP of some other entity. Are those two entities related parties? In AS 24, takes care of all these relationships and covers all these relationships within the ambit of related party relationships. To understand it a little more better, let us look at each of these clauses separately. Say I am a reporting entity, I am a company X. My holding company is my related party, my subsidiary is my related party, my fellow subsidiary is my related party, and we all are together considered as one particular group, and all the members of the group inter se are related parties. So the group is there. Holding company, fellow subsidiary, and I am the company X. My holding company has an associate, and I have a JV. I have a joint venture with somebody, and my holding company is an associate of the same holding company. Those two parties inter se are also related parties. Because while one is an associate of one member of the group, the other is a joint venture of another member of the group. So even if you happen to be an associate or joint venture of different members of the group, inter se you are related parties. See how wide the canvas has become. I have two joint ventures. Those two joint ventures inter se are related parties. I have one joint venture and another associate. Those two companies are also inter se related parties. I am Mr. X and I am holding more than 50% either myself or together with other persons over whom I have control, more than 50% of say 40 other entities. All those entities intersay with unrelated parties. I am a person who is holding more than 50% over one company X. And I am in a position to exercise significant influence over two other companies, which means I am holding more than 20% shares in two other companies. X and those two other companies intersay become related parties. I am exercising significant influence over A Limited and B Private Limited. I am holding more than 50% in the reporting entity. Then the reporting entity and A Limited and B Private Limited intersay also become related parties. If Mr. A happens to be a KMP of some other company, holding company of a company over which I am exercising significant influence, then the reporting entity and that holding company of a company over which I am exercising significant influence, they also intersay with unrelated parties. So you can see that Ind AS 24 covers several relationships between entities as related party relationships. And all those related party relationships, plus the first part of Ind AS 24, which is individual based, all those related parties, the person and the close member, plus all those related parties who are deemed as your related parties, which means the promoter and all those persons holding more than 10%, plus all those related parties as provided in section 2, subsection 76. For a listed entity, all these persons or entities are your related parties. And you have the onerous task of compiling this entire database of related parties. You have the onerous task of ensuring that whenever a company enters into a transaction with any of these related parties or any of these related party relationships, necessary compliances as required under various regulatory provisions are complied with and taken care of. To say it sounds very simple, but in practicality, it's really, really going to be a very, very difficult exercise. Then there are certain exemptions. For example, you have taken, your lenders are not your related parties. Your trade union is not your related party. If you have procured electricity from, say, some electricity board, a public utility, that doesn't happen to be your related party. Your major customers, unless they fall under any of those, they don't become your related party. Merely because two entities have a common director, they don't become your related party unless, of course, the second entity happens to be a private limited company. Similarly, it is only when person A is exercising control over the reporting entity. If Mr. A has significant influence over 20 other companies, those 20 other companies inter se do not become related parties. Please understand that. Only when Mr. A is in a position to exercise control over 20 different entities, then those 20 different entities inter se become related parties. But Mr. A only has 20% in all, or say 22% in all those entities. He is individually exercising significant influence over each of those entities. He individually is a related party to each of those entities. but each of those entities inter se do not become related parties. Right? So you have to be very, very clear as to which related party relationship requires compliance and which is not a related party relationship, which would require compliances under the regulatory rules. Now, having understood who is a related party, we now need to understand what are related party transactions. Mr. A is my related party. If I simply shake hands with Mr. A, that doesn't mean that I am entering into a related party transaction with him. I have to enter into some kind of transaction with my related party to make necessary compliances. Is there any limit or is there any restriction on the kind of transactions that require compliance, or whether every transaction requires compliance? That has to be understood. If you are not a listed entity, then the only related party transactions which require compliance are those listed under Section 188 of the Companies Act. If you happen to be an unlisted public company above a particular threshold, then besides Section 188, any transaction that you happen to enter into with a related party will also require compliances under Section 177. There are certain transactions which may call for compliances under Section 177, but which may not need any compliance under Section 188. So you need to clearly understand what are the related party transactions and what compliances are needed for such related party transactions. Let us look at the related party transactions that are covered under Section 188. Any sale, purchase, supply of goods, materials, selling, buying property of any kind, leasing of property of any kind, availing or rendering of any services, appointment of any agency, similarly, holding any office or place of profit or underwriting of securities. Almost every kind of transaction that you can think of seems to be falling under Section 188. The only notable exception is financial transactions. Loan transactions are not covered by Section 188. Other non-funding transactions such as a contract of guarantee or a contract of security is not covered under Section 188. So 188 generally covers all those transactions relating to material or supply of goods or properties, renting of properties, hiring of properties, and service contracts, agency contracts. So as far as 188 is concerned, the ambit of transactions is very limited. It covers all kinds of transactions that you can think of except financial transactions. Financial transactions are not covered within the ambit of Section 188. But if you happen to be a listed entity, then you will see that any transfer of resource, services, or obligations between two entities would be a related party transaction. Whenever there is a transfer of resource, whenever there is any transfer of services, whenever there is any transfer of obligation, regardless of whether price is charged or not, all such transactions would be related party transactions under LODR. So if you are a listed entity, every transaction, including financing transactions because there is a transfer of resource, including guarantee transaction because there is a transfer of obligation, all those transactions would also be covered as related party transactions. Unless, of course, LODR exempts certain kinds of transactions. Ind AS gives examples of certain related party transactions. As you can see, purchase or sale of goods, purchase or sale of property, rendering of services, leases, transfer of research, transfer under license agreement, finance arrangements. Now see, Ind AS, as I said, Ind AS is a disclosure requirement. Now, if you are not a company which is listed, but to which Ind AS is applicable, in case of finance arrangements, while you may need to disclose your finance arrangements as related party transactions under Ind AS, you don't have to make any compliance under section 188 because 188 doesn't cover these kind of transactions. But if you happen to be a listed entity, then even all these kinds of transactions would be covered as related party transactions. The next important question that we need to ask is, if I am not a listed entity, then do I have to make no compliance at all with respect to a related party transaction relating to financial arrangements? The answer is, while 188 limits itself only to certain types of transactions, if you happen to be a public company above certain thresholds, then you have to comply with section 177. And in respect of 177, there is no distinction between a section 188 transaction or a financial arrangement. Every transaction with a related party requires compliance under section 177. What is section 177? We will see in a while. So, transactions as listed in section 188 plus transactions as provided in LODR, if you happen to be a listed entity. I don't think anything is left out. Any transaction, every transaction, only those transactions which are specifically exempted are left out. Otherwise, every transaction is covered. But transaction with whom? If I am a company, I am entering into a transaction with my related party, is that only what is covered? If I happen to enter into a transaction with a related party of my subsidiary, am I required to make any compliance? If I happen to be, if I happen to be an entity who has related parties and my subsidiary enters into transactions with my related party who are not related parties of the subsidiary, do I need to make any compliance with respect to those transactions? Prior to 1st April 2022, it is only my transactions with my related parties which were regulated. If I am a company A, I have 10 different related parties. If I am entering into transaction with any of those related parties, compliance was required. If I have subsidiaries, and if those subsidiaries enter into transactions with their related parties, they have to make necessary compliances. If I enter into a transaction with related party of a subsidiary who is not my related party, until 1st April 2022, no compliance was needed at my end. Ramesh Srinivasan committee deliberated this issue, and they strongly recommended that even these not only transactions by an entity with its related party which needs to be regulated, but even transactions which are entered by subsidiaries of a listed entity with its related party or with the related party of the listed entity, they also need to be regulated. Similarly, if a listed entity enters into a transaction with related party of a subsidiary, and such related parties don't happen to be listed entities related parties, even compliances need to be done in respect of such transactions as well. And then all these transactions which were unregulated prior to 1st April 2022 have now been covered by SEBI LODR's 6th Amendment regulation. So it is not only a transaction between a company and its related party, but even transactions entered into between a subsidiary of a listed entity with its related party or with the related party of the holding company, the listed entity, or a transaction by the listed entity with the related parties of the subsidiaries, they also will be covered within the ambit of related party transactions. So now the structure would look like this. Any transaction that you may enter, A enters with C1 or C2, B enters with A1 or A2 or C1 or C2, C enters with B1, B2, C1, C2, A1, A2, everything needs to be reported in the hands of A, unless B and C also happen to be listed subsidiaries. But if they are not listed subsidiaries, then everything needs to be reported in the hands of A, needs to be complied with in the hands of A. The canvas seems to be increasing with every passing day. And these are the specific related party transactions which are exempt under LODR. If you are making any preferential issue of securities, any preferential issue, then such an issue, though the subscriber may be a related party, but then such an issue will be an exempted related party transaction. Similarly, dividends being paid by a company to its related party, rights issue, buyback, bonus, all those will not be related party transactions. Apart from this, any other transaction that you enter with a related party, if you happen to be a listed entity, then everything will be done. And please also note that transactions done by a subsidiary of a listed entity with its related party or with the related party of its holding company, or transactions done by the holding company with the related parties of the subsidiary, compliances are needed only in respect of listed entities. If you are not a listed entity, then those transactions does not require any compliance under the Companies Act. Don't be over enthusiastic. And if you happen to be an unlisted public company, don't treat related party transactions between subsidiary and its related party as your own related party transactions. If you comply, it's better, it's welcome, but you don't have to meet any such compliances if you are not a listed entity. So when we are talking of listed entity, we are talking of companies over a particular threshold, etc. The status of a company becomes very important. The status will decide what compliance you need to make. The status will decide whether you need to comply with only one particular section of the Companies Act, or whether you need to comply with all the provisions of the Companies Act. The status will decide whether you will need to comply with LODR or whether you don't need to comply with LODR. So status of a company will determine the level of compliance that a particular company needs to make. If you are a private company, or if you are an unlisted public company, below certain thresholds, which means your paid up capital is less than 10 crores, your turnover is less than 100 crores, your borrowings are less than 50 crores, then the only provision that you need to comply with is Section 188. But if you happen to be an unlisted public company above the thresholds, which means your paid up capital is more than 10 crores, your turnover is more than 100 crores, your borrowings are more than 50 crores, then besides Section 188, you also need to comply with Section 177. Similarly, if you happen to be a listed company, which is listed only in the SME platform, or a listed company whose paid up capital is less than 10 crores and whose net worth is also less than 25 crores, then these several requirements of LODR, even Regulation 23, are not applicable to you. And you don't have to comply with anything that is provided in While section 188 and 177 have to be complied with, but majority of the provisions of LODR, despite you being a listed company, will not be applicable to you. But if you happen to be a listed company on the main board, then everything is applicable to you and you have to make all the necessary compliances. So if you happen to be a company above a public company above particular threshold, section 177 becomes applicable to you. And section 177 says that you are required to take approval of audit committee for all the transactions that you enter with related parties. 177 does not limit itself to transactions covered under section 188. It says that any transaction of a company with related party will require approval of audit committee. Of course, there are certain exemptions, there are certain exceptions provided to this particular requirement in certain cases. The approval of audit committee is a must. But if your transaction happens to be a non-section 188 transaction, say a loan transaction, and your audit committee does not approve such transaction, then you're in all other cases, those transactions cannot be entered at all. Board cannot override what the audit committee has decided. Only if it happens to be a non-section 188 transactions, then the audit committee can forward its recommendation to the board, and then the board can decide whether this particular loan transaction has to be entered into or not, despite the negative reference by the audit committee. Similarly, in case of urgency, if you happen to enter into a transaction, the amount of which does not exceed 1 crore, then instead of prior approval, you can take approval of the audit committee within 3 months of entering into that transaction. If you are not a section 188 transaction, and if the transaction is between, say, loan is driven by a holding company to its wholly owned subsidiary, then the requirement of taking approval of audit committee is not needed. But if a transaction is there between a holding company and its wholly owned subsidiary in relation to supply of materials, then there is no exemption under section 177. This holding company and wholly owned subsidiary, again, different provisions provide for different types of exemption, and you need to understand each one of them very, very clearly. So 177, audit committee's approval. 188, if you enter into those transactions which are provided in 188, you need board's approval. And if the value of those transactions is above a particular threshold, then you require shareholders' approval. And in case of shareholders' approval, all those related parties which are parties to those transactions, they cannot vote on such resolutions. That is as far as unlisted companies are concerned. But if you happen to be a listed entity, then all your transactions, whether it is financial transaction or 188 transaction or any transaction, it requires prior approval of the audit committee. As I already said, even if it is a transaction between a subsidiary and its related party, it will also require prior approval of the audit committee of the listed entity. Of course, there is certain monetary limit to such transactions. 10% of perhaps the annual standalone turnover of the last audited financial statements of the subsidiary. So, audit committee's approval under section 177, audit committee's approval under regulation 23 of LODR, Board's approval under section 188. LODR doesn't talk of any board approval, but it's understood. And if you have entered into any material related party transaction, Companies Act Rule 15 has some threshold. Regulation 23 has a different threshold. 1,000 crore or 10% of the consolidated turnover of the listed entity as per the last audited financial statements. Then in those cases, you also need approval of shareholders. Now, in case of listed entities, in case of unlisted entities, only parties to related party transactions are prevented from voting in respect of shareholders' resolutions. But in case of LODR, all related parties are prevented from voting in respect of such material related party transactions. All material related party transactions, even their subsequent modifications, material modifications will require prior approval of shareholders, and no related party shall vote on such transactions. So audit committee's prior approval, regulation 23. Shareholders prior approval, if you happen to enter into a material related party transaction. Board's approval, section 188, you are a company, so you need to comply with 188 as well. If you are not a listed entity, then 177 and 188, which means audit committee's approval, board's approval. And if it is above thresholds as provided in Rule 15, if there is a conflict between thresholds given in Rule 15 and Regulation 23, then the lower will prevail. All these have to be taken care of when you are proceeding with compliances in respect of related party transaction. A company entered into a related party transaction, and when such a related party transaction was entered, the related parties abstained from voting as is required under Regulation 23. And after some time, the company decided to rescind that particular transaction, not to proceed with that particular transaction. And since the decision was taken by the shareholders, the decision to rescind also has to be taken by the shareholders. The matter went back to shareholders for rescission of that particular transaction. There, all the related parties voted on the resolution. So a question arose that when you are abstained from entering into a related party transaction, abstained from voting in respect of a shareholder's resolution, considering the related party transaction, are you also required to abstain at the time of rescinding that particular resolution? The Supreme Court said that no. SAT said yes, it's required, but Supreme Court said no. The view taken by appellate tribunal in the set of facts and circumstances appear to be, SAT said no, it's not needed, and Supreme Court confirmed that, saying that it appears to be a plausible view of the matter. The hyper-technical stance of the appellant could have only been and has rightly been disapproved on the given set of facts and circumstances. SEBI was of the view that yes, even at the time of rescinding, the related parties will not be allowed. Now here again, certain transactions, this requirement of audit committee's approval or shareholders' approval are not applicable. And one such transaction is transactions entered into between two wholly owned subsidiaries of listed entities whose accounts are consolidated. Similarly, a transaction entered into by a company with its wholly owned subsidiaries whose accounts are being consolidated. No approval is needed as far as Regulation 23 is concerned. Now, let us quickly look at the provisions relating to holding subsidiary. I already told you that section 2, subsection 76, clause 8, which says that your holding company or subsidiary is a related party, does not apply with respect to section 188 to a private limited company. So in case of a private limited company, even transactions with holding subsidiary 188 has no compliance. 177 subsection 4, you only don't need audit committee's approval for non-section 188 transactions between holding company and its WS. But for section 188 transactions, you will still need audit committee's approval under the Companies Act. Now see this interesting issue. If you look at 23(5)(b) below, you don't need audit committee's approval, you don't need omnibus approval, you don't need shareholders approval in case of any transactions entered between a holding company and its wholly owned subsidiary. But as far as Companies Act is concerned, this exemption is only for non-section 188 transactions. So if it is a transaction relating to sale or supply of materials or goods, while regulation 23 doesn't require any approval, but because of section 177, you still need to take audit committees. Similarly, in case of shareholders resolution, there is a provision, even section 188 says that shareholders resolution is not necessary for transaction entered between a holding company and its wholly owned subsidiary, whose accounts are consolidated. Thankfully, in case of shareholders resolution, the proviso to 188(1) and regulation 23(5)(b) does not have any contradiction. But as far as audit committee's approval is concerned, LODR exempts everything in respect of transactions between a holding and its wholly owned subsidiary. But Companies Act still makes audit committee's approval necessary in respect of a transaction between a holding and its wholly owned subsidiary, to whom section 177 applies. Friends, I think we need to move on to the other topic. We'll touch upon. I think the majority of the issues we have touched upon. The Institute has come out with its guidance note, and it has provided you a guidance on the transactions that will be covered. Preferential allotment, the LODR specifically now exempts, but the Institute in its guidance note has also provided that preferential allotment will not be treated as a related party transaction. Similarly, a leave and license agreement is not treated as equivalent to leasing of a property. But however, since it's a transaction with so 188 will not apply to it, but since it's a transaction with a related party, 177 will still apply to it. In any case, if you're a listed entity, everything applies to it. So Institute has provided guidance on some of the transactions, but some of the issues which still remains complicated are the appointment of a person, of a director as a managing director. When I am paying him remuneration for the services rendered, will that be a related party transaction? If a promoter director happens to be appointed as a whole-time or a managing director and remuneration is being paid to him, will it be a related party transaction? Is there any distinction between a contract of service and a contract for service? Whether those contracts for service where a person is appointed as a managing director or a full-time director, and there are plethora of sections under the Companies Act which provides for various compliances that are needed to be done for appointment of a person as a managerial person, whether still related party transactions, requirements relating to related party transactions need to be complied with. Of course, under the accounting standards in the financial statements, remuneration paid to these managing directors and full-time directors are disclosed as related party transactions. but whether at the time of their appointment, will all the do I need to comply with RPT requirements or regulations, and whether all the related parties, which means every related party of a company, which also includes promoter now, will they all be prevented from voting? A study of companies has shown that even large corporates have been following different views. Some have been treating them as related party transactions, but majority of them have been treating them as a contract for service, which doesn't require any, it's not a contract of service, so it doesn't require any compliances with related, in respect of related laws relating to related party transactions. This is one area which really needs to be looked into. Similarly, there are several companies in one particular building, in one particular room. You provide rent-free space for formation of 70, 80 companies which you have within your organization. There is no rent agreement between these companies, but yes, a letter is provided as rent-free accommodation. Will these letters, which are rent-free accommodation letters for provision of a registered office, will they also be treated as related party transactions? Because SEBI LODR says whether any value is involved or not. Similarly, if a particular company has a habit of making payment of all ROC or income tax or other expenses through one particular entity, they have one particular credit card, they use one particular internet banking account to make all these transactions, and thereafter reimbursements are collected. So whether reimbursements would also be treated as related party transactions, because though for 10 minutes or maybe 30 minutes or maybe for one day, there is a transfer of resource for a particular period of time, whether those would be related party transactions. Well, not many questions have been asked with respect to these kind of transactions, but yes, there may be a time when even these transactions may be taken as related party transactions. You have several disclosure requirements, both under LODR as well as under the Companies Act. Framing of a policy is must. Policy on materiality of related party transactions. And you also have to disseminate this policy under a separate section on your website. Similarly, Section 188 requires you to disclose in your board's report justifications for entering into related party transactions. Section 134, which deals with the board's report, says that you will have to include the particulars of your contractor arrangement with related parties, and you have a separate form, AOC 2, if I'm not wrong, for such kind of transactions. Similarly, under the LODR, you have to submit your details of your related party transactions in a specified format and publish it on the website. Previously, it was within 15 days of your publication of standalone and consolidated financial results for the 5.5 years, but now it is with the date of publication of the standalone and consolidated financial results. Similarly, you also have to, your annual report should contain RPT disclosures as specified in para A of Schedule 5. So both under the Companies Act as well as under LODR, you have requirements of disclosing various details about your related party transactions, either in Form AOC 2 or at the end of the half year in a specified format, or even in your annual reports in the given format. What is also important to understand is that now, even when you are putting up these transactions for approval of the audit committee or approval of the shareholders, and if you happen to be a listed entity, then LODR says that this is the information that you need to provide to the board of directors to take an informed decision, or to shareholders to take an informed decision. As you can see, the information talks in detail about the related party transaction, the value, the tenure, the justification, why you are entering into any, whether there is any external valuation report obtained in case of, say if there is a property which is to be transferred to a related party. All the information that is relevant for a person to understand the need for entering into such related party transaction, that is relevant for a board or a member of an audit committee to decide whether it is necessary, imperative for a company to enter into such related party transactions. All those disclosures are also required to be made. Friends, this is all about, I think we will have to switch on. Time is moving on. We could have covered some more issues relating to related party transactions, but we will stop at that. I will only conclude by saying that having understood who your related party is, having understood what kind of transaction are you entering into with your related party, the status of your company will decide what compliances you need to make. You have to see the level of compliances for different types of companies is different. Even within a category of companies, say if you happen to be a listed entity, it is not for all listed entities that there is same level of compliance. In respect of listed entities also, depending on the platform where you are listed, depending on what your capital or net worth is, it will be decided whether you need to make a higher level of compliance or whether there is some relaxed level of compliance that is applicable. That's all about related party transaction. I think we can take questions at the end of both the lectures, or do I need to wait and first take questions on related party transactions? Any guidance on that, Mr.
No, I think we will proceed, Manoj.
We'll proceed, right. Now we come to Regulation 30. This is one particular issue that has been really troubling listed entities to a great extent. When should I disclose? What event should I disclose? How do I assess whether a particular event will have an impact on the prices or on the perception in relation to my entity or my company or not? A delayed disclosure, what will it lead to? How SEBI will view these delayed disclosures? There is some information floating in the papers. Do I need to immediately rebut it, or do I need to wait? And if there is truth about the information, which I have not taken any concrete decision yet, but do I need to confirm that because it is come in papers? This is. I mean, every company faces these kind of problems. And as a compliance officer, the company secretaries face the biggest challenge of timing of disclosure and the extent of disclosure. And to decide whether a particular event is material enough to be disclosed or not. And this is a problem which is not unique to India. World over, this has been a problem. Even the Securities Exchange Commission in USA has come with a directive on materiality. New York Stock Exchange's listed company manual has provided the importance of timely disclosure, has stressed on the importance of timely disclosure of material news developments. What we have Regulation 30 here in India, and what we have in Para A of Part A of Schedule 5 in India, we have similarly Form 8K events in the United States. And whenever these Form 8K events are triggered, forgetting the materiality concept, forgetting whether they are material or not, all these events have to be disclosed. Whether it's a current written report or whether even if it's a verbal thing, somebody talking about the company, then also there is a need to either confirm or rebut those press releases or those releases in newspapers. So world over, this has been a problem, whether it is USA, whether it is Australia, even smaller countries like Malaysia, they all have regulations which stresses on the need to provide information which is material and omission of which is going to result in a person not able to take valued decision with respect to the company's securities. There may be a great movement in price or in the market activity or in the value of a company's securities based on that particular material event or information. Then those material event or information has to be disclosed immediately within the given time thresholds. Even world over, the two approaches to materiality, the two approaches to material events are common. There is a presumptive approach. We also in India have a presumptive approach. Irrespective of the value, these transactions have to be disclosed. These events have to be disclosed. That's para A. So this is called as a presumptive approach. Then you have a policy or a guidelines-based approach, that these are the events. You frame your own guidelines with respect to these events. And based on the triggering of those events, on the basis of the guidelines that you have framed, you have to provide necessary disclosure. So the presumptive approach and the policy approach is common world over. Even in this policy approach, I will frame guidelines for determination of materiality. Now, these guidelines are subjective. They are based on my opinion. They are based on the management's opinion of a particular company. But now the regulator says that, yes, you don't have to worry about that. We give you a measurable criteria to determine materiality. Your subjective decision, if you happen to fall within this measurable criteria, then yes, you have to disclose those events. Otherwise, you can take use of your guidelines to decide whether a particular event is material or not. So Regulation 30 says that every listed entity has to make in disclosure of any information, which in the opinion of the board of directors of the listed company is material. So if the board forms an opinion that a particular event is material, I have to disclose. There is no stop in the board. You can always disclose any event that you want under Regulation 30. But if it happens to be an event specified in Para A of Part A of Schedule 3, then irrespective of the value, irrespective of whatever policy that you have framed, irrespective of whatever guidelines that you have provided for determination of materiality, you have to disclose those events within the timelines provided in that particular schedule or that particular regulation. With respect to other events, which are again provided in Para B of Part A of Schedule 3, you can frame a policy, you can frame a guideline, and based on that, you can decide whether that particular event is material or not. We provide you the criteria on the basis of which you have to determine materiality. Previously, we provided you qualitative criteria. If the event is likely to disclose alteration of event or information which is already available publicly, if the event is likely to result in significant market changes, then we have provided you qualitative criteria. But now we have also provided you with quantitative criteria. You means SEBI, we means SEBI. We have provided you with a quantitative criteria. That if any of your event whose value or expected impact of such value is likely to exceed the lower of any of these three parameters. 2% of turnover as per last audited financial statements, 2% of net worth, negatives to be ignored, 5% of average of absolute value of profit or loss after tax, minus sign to be ignored. Then a lower of any of these two, if a particular event is likely to have an impact to this extent, then you have to disclose that event will be considered material and you will have to disclose that event. So besides the qualitative criteria which is provided in 34, you now also have in 34C. 34A and B are qualitative criteria, but 30 subregulation 4C is a quantitative criteria. 2% of turnover, 2% of net worth, negatives ignored, 5% of average of absolute value. Absolute value means if you have 20 positive, 30 negative, 30 negative, remove the minus signs, 30 plus 30 plus 20, 80 divided by 3 will determine what will, the 5% divided 5% of the average would determine whether the event is material or not. So, and when these regulations, the amendments have come in, if there is any continuing event or information which has become material by virtue of this criteria, then even those events need to be disclosed within 30 days of the coming into effect of the regulations. So a presumptive approach, no criteria needed, no materiality to be determined, they have to be disclosed. For para B events, yes, criteria has to be determined. Criteria for determination of materiality has to be fixed. First, see the quantitative criteria. If you hit the quantitative criteria, disclose. If you don't hit the quantitative criteria, look at the qualitative criteria. If you still feel that yes, qualitative criteria is being hit, then you have to disclose those events as well, even if they don't fall under these material thresholds. Right. Now, what is the time limit? When should I disclose these events? This para A of part A of schedule 3, this itself contains certain time limits. Those time limits have to be followed. Whatever time limits is provided in para A, part A of schedule 3, that has to be complied with. Apart from that, any event where a decision has been taken at the meeting of the board of directors, in respect of which a decision has been taken at the meeting of the board of directors, then within 30 minutes of the closure of the meeting, you have to disclose that event. If there is an event which has not been decided at the meeting of the board of directors, but which has emanated from within the listed entity itself, then within 12 hours of the occurrence of that event, it has to be disclosed. But if an event has not emanated from within the listed entity, then within 24 hours of the occurrence of that event disclosure has to be made. I repeat, if there are any timelines provided in para A, part A of schedule 3, those timelines have to be complied with. In all other cases, if decision taken at the board meeting, within 30 minutes of the decision of the closure of the meeting. If events emanating from within the organization, 12 hours. Events emanating from outside the organization, 24 hours. Somebody enters into agreement which has an impact on the company is not aware of it. They have, how do that's not an event happening within an organization? How do I disclose those events? They come to me, I come to know about them only at a later point in time. Those people, whether do they have any obligation to disclose those events? SEBI now says, SEBI has now come with a new regulation 30A, which puts an obligation on persons who enter into transactions, who enter into agreements to which the company itself may not be a party. But the whole purpose and effect of that particular agreement is to impact the management and control of the company. The whole purpose and effect of that agreement is to impose restriction on the company or to create any liability on the company. If significant shareholders enter into those transactions, if promoter group enter into those transactions, whether they are promoters of the company or its subsidiary or its associate or its holding company. So now an obligation has been cast on them to inform the listed entity of any such agreements within 2 working days of entering into such agreement. So it is only when those people inform the listed entity that the listed entity comes to know of such agreements. And it is only then that the listed entity will be in a position to disclose those events. Say there is a fire within the organization. It is something which is happening within the company. Within 12 hours of the occurrence of that event, you have to disclose the event or information. If it is material enough to be disclosed, then that has to be disclosed within 12 hours because it is something which is emanating from within the organization. Now, whether a particular event is material or not, the board of directors will have to make one or more KMPs responsible for that. One or more key management personnel, they have to be responsible. The board will authorize one of them to determine whether a particular event is material or not based on the guidelines or policy framed by the board, which consists of qualitative and quantitative factors. Now, new amendment has come in which says that the policy should be such that it will assist the relevant employees of the listed entity in identifying the material event and reporting the same to the KMP who has been authorized by the board to determine materiality. So board authorizes a KMP. Now this KMP, board has also formed the guidelines. Now this KMP will be assisted by employees who will be guided by the policy. The policy should be such that it will assist these employees to identify potential material event and report the same to the group. I really fail to understand the whole purpose of this regulation. I mean, naturally, if there is a fire on the shop floor, then an employee who is there in the shop floor, and if the fire is big enough which needs to be reported, then naturally he is going to inform the KMPs that yes, this is going to have a potential, it is a potential material event. So I have a duty to inform it to you. And I inform the KMP, and the KMP in turn will decide whether it's material or not. And if he feels that it's material, then he will make the necessary disclosure as required under the LODR. SEBI has come out with a guidance, a circular on 13th of July, where they have provided us with guidance on the time of occurrence of events. And this guidance says that in case an event requires discussion, negotiation, or approval, then that event will be said to have occurred only upon receipt of approval by the board of directors. Exploratory exercises are not events. You want to acquire a company, you are scouting for various companies and trying to find out whether that particular business you need to acquire or not. Even after deciding on a particular business, you need to carry out due diligence with respect to that particular business. It is only upon completion of due diligence you will finally decide whether you will take over that particular company or not. Before doing due diligence, you enter into some kind of term sheet. That term sheet doesn't determine that you have decided to take that particular company. It is only after completion of due diligence and finalization of price, when the board finally approves acquisition of a particular company, that is the decision, that is the time when you need to inform with respect to that particular decision. Not when you have now. Similarly, there may be certain cases where approval of shareholders might be necessary to enter into a particular transaction or to enter into with respect to a particular event. Then in those cases, only when those approvals are needed that you need to disclose. In case of natural calamities, when the company becomes aware of such calamities, it has to disclose those events. And the guidance further says that if an officer of the company, if he is ought to have reasonably come into the possession of such information in the performance of his duties, then awareness of that officer would be considered as awareness on the part of the company, and the company would become responsible for disclosure of those events. And as far as any information in the mainstream media is concerned, the company has 24 hours to either confirm or deny or clarify. Friends, the presumptive material events are provided in, as I said, Part A of Para A of Part A of Schedule 3. It consists of all these material events. The only 2-3 events which I need to highlight is point number 5, which talks of agreements which are binding and are not in the normal course of business. Shareholders agreements. It gives examples of family settlement, shareholders agreements, joint venture agreements. Now, if a company is party to those agreements, yes, you become aware of those agreements and you have to disclose those agreements. But if a company is not a party to those, or if inter se those agreements happen between the parties and company is not a party to it, then company doesn't become aware of those agreements. I have already taken you through Regulation 30A, which places an obligation on those people to inform the company. A new clause has been added after 5A with respect to those agreements, whether companies are party to those agreements or not. Even when the agreements are entered inter se between promoters, employees, shareholders, etc., those also need to be disclosed, because those people have an obligation to disclose it to the company, and company now has an obligation to disclose even those agreements, because those agreements are likely to have an impact on the management and control of the company. See, there are several agreements. You enter into an agreement. There is a shareholders agreement which says, so long as I am holding 26% shares, I am holding 26% shares in the company, and I will be entitled to, say, a seat on the board of directors of the company. The agreement is silent with respect to what will happen to my position if my shareholding is diluted beyond 26% and it comes to an abysmally low level of, say, 5%. Will I still be entitled to a position on the board of directors of the company? If the agreement entitles me to such seats, then shareholders have an obligation to know such agreements. Normally, a seat on the board of directors is proportionate to the right that you have in respect of a particular company. And if you don't have shareholding which will entitle to a directorship, merely at some point in time you had some good amount of shareholding and subsequently it gets diluted, but because of an agreement you are protected and you still continue with those directorships, then your shareholder needs to know of such agreements, and those are material agreements that need to be disclosed. Point number 6 is also relevant. Any fraud or defaults by promoter KMP are listed in. This is the earlier clause. If a fraud is committed by promoter of an entity, I need to disclose. It's a material event. Fraud is committed by KMP, it's a material event. fraud is committed by listed company, it's a material event. What happens if a fraud is committed by an employee of a subsidiary? What happens if a senior management personnel of a company commits a fraud? He is not a TMP. What happens if a director, promoter need not be a director, TMP need not be a director? What happens if a director commits a fraud? A director who is neither a TMP nor a promoter. They have now made amendments to include even today they have included fraud by subsidiary, but they have not included fraud by employees of subsidiary. They have not included fraud by TMPs or SMPs of subsidiaries. We have seen listed entities reporting fraud by employees of their subsidiaries. While this Clause 6 has been expanded, still there is a scope, and I'm sure in time to come, they will even include employees of subsidiaries within the ambit of material events that need to be disclosed. Similarly, changes in directors, TMPs, now even changes in SMPs. If there is any change in senior management, then it is considered as a material. Senior management has a definition. All those who are one level below the board of directors of the company, including the functional heads. And a company has, say, 10 different functional heads. And whenever there is any change in any of those functional heads because of the new definition, because they happen to be SMPs, I need to inform. And if any of these people resign, then I will have to give their resignation letter along with all the details to the stock exchange. Though the time limit is 7 days, but I have to disclose the resignation letter. When an SMP resigns, I have to disclose. When a TMP resigns, I have to disclose. When a compliance officer resigns, I have to disclose. I can understand when a TMP or a director or a compliance officer is resigning. Even when an SMP resigns, I will have to disclose the letter. If he is disgruntled, if he writes 20 things about the company, those will now be in the public domain. If there is any schedule of analysts. Now, interestingly, if you look at sometimes the language becomes a bit of casuality. The language used is that in case of resignation, you have to disclose within 7 days of the resignation coming into effect. I resign today saying I will resign with effect from, say, 1st of September, or say with effect from 31st of August, I'll resign. Now, do I wait because it is coming into effect on 31st of August? Do I wait till it comes into effect? And then within 7 days from that, do I inform? That's not the intention. The intention is the moment I get the resignation. Since it's a contractual relationship, the moment it is accepted, I have to disclose. But the kind of language we sometimes use, coming into effect of the resignation, that creates a problem in compliance. My advice to all of you would be that the sooner the better. Once your board decides to accept the resignation, go ahead and disclose it. Don't wait for it to come into effect. That was an unintentional addition, surpluses to the language. That was not necessary at all. Similarly, I have already spoken about these agreements. This is one, though not a part of our topic today, but you must be aware that if there are any special rights which are granted to shareholders, then those rights will now require approval of shareholders in a general meeting by way of a special resolution every 5 years. Whatever special rights which a particular shareholder enjoys, several times we have seen government comes in as a joint venture partner. They remain a small joint venture partner. And the agreement says that until their entire shareholding is diluted, you will be entitled to take the permission for doing these in the company, these events in the company. Now, even if after the increase in shareholding of the company, the government shareholding has come down from, say, 26% to 2.6%, but by virtue of that agreement, they still have those special rights over the company. Shareholders need to be made aware of those rights every 5 years. There are certain exceptions, but yes. Similarly, sale, lease, or disposal of undertaken. Now, this was not covered even in this particular as a part of a material event. Only acquisitions and sale or disposal of any unit, division, or subsidiary, but not any sale or disposal of any undertaken or substantially the whole of the undertaken. That was not covered previously in para A, part A of schedule 3, but now that will also be required to be disclosed. And shareholders' approval for such is required to be taken. And when you are taking such shareholders' approval, you will have to give the complete object for entering into such transactions, the commercial rationale. Very recently, it was observed in case of a company which had only 2 of its undertaken. Necessary approvals were taken under section 180 of the Companies Act, and both the entities, both the manufacturing units of that particular company were sold off. The company was left with almost no business. It was a listed entity left with no business and no major cash at its disposal at all to take any other new business at all. Shareholders were totally left in lurch. So those now it says that yes, when you are entering into any kind of, when you are passing any kind of resolution, then the votes cast by public shareholders should exceed the votes cast against by public shareholders. So majority of minority is needed for any sale, lease, or disposal of undertaking. And that sale, lease, or disposal of undertaking will also be considered as a material event, and it also is required to be disclosed, irrespective of the value. Friends, I'll just take 4 or 5 minutes more. I hope I have that much time. I just want to take you through certain case studies. This is a case which was, a settlement order was passed in this case on 5th of November 2019. Board of Directors of PC Jewelers approved buyback of shares, and thereafter they were supposed to take NOCs from their lender, but SBI refused to give them NOC in respect of buyback of shares. So they made a corporate announcement withdrawing the buyback offer, but they did not disclose that SBI has refused to give them NOC with respect to the buyback offer. Even this point that SBI had refused was not disclosed by them. SEBI said that it was a material information that was required to be disclosed, and by a settlement order, they had to pay a penalty of, they had to pay settlement charges of 19.125 lakhs of rupees. In yet another case, DS Kulkarni, the adjudication officer passed a penalty order of 10 lakhs. Here, it was noticed that there were several instances where the company had failed to disclose or made delayed disclosure of material events. They had done defaults with respect to loans to banks and financial institutions. Company was referred to IBC. I mean, there were instances where the company actions were taken by the creditors against the company in IBC, etc. Now, SEBI, those were material events that were required to be disclosed. And since the company did not disclose them, the adjudicating officer levied a penalty of about 10 lakhs on them. Another interesting case of 5 Core Electronics Limited. It was decided on 23rd of July 2020 by the adjudicating officer. Here, the outcome of the board meetings were not filed for several years, for almost, since April 2019. The CFO, the CS, the compliance officer, independent directors all have tendered their resignations, but no information was provided to the exchange. There were several other allegations against the company with respect to misutilization of funds, etc. So inter alia, covering all these points, even for violation of regulation, including violation of regulation 30 by an interim order, they were restrained the noticee from accessing the securities market, freeze their assets, and appointed an independent auditor to conduct a detailed forensic audit. It is only after the detailed forensic audits, maybe monetary penalties would also be imposed on them. We have a very interesting case of Reliance Industries Limited. this is a very one of the recent adjudication orders passed on 20th June 2022. There, you all have heard of the news floating about Facebook investing in Geo. This was in 2020. Then Geo deal was published in Financial Times London. Then it was also reported widely in Indian media. And as you can see, the news articles, they said that yes, Facebook is seeking to buy this company. They have closed a preliminary deal, etc., etc. And the strip price of the company saw a upward movement. However, no clarification in this regard was issued immediately by Reliance. After a lengthy adjudicating proceedings, finally the notices were levied, were found to be in violation of Regulation 30, and a penalty of joint and several penalty of 30 lakhs was imposed on them. Vedanta, a very recent case, decided on 30th June 2023 itself. A news article was published on Bloomberg where it said that Vedanta will partner with Foxconn for manufacturing semiconductors in India. Vedanta also in its earlier press release has said that Vedanta has signed MOU with government of Gujarat for manufacturing or setting up hubs to manufacture semiconductors. Vedanta disclosed to stock exchanges that Vedanta did not make any such disclosure to stock exchanges, and when Vedanta was questioned, it said that it was not into any semiconductor business. It was that semiconductor business was to be undertaken by the holding company of Vedanta Limited. So Vedanta was confronted with the press release that it made earlier, that you had said we have signed MOUs with government. Now you are saying that your holding company will do the business. Why this contradiction? So they were again held to be in violation of Regulation 30, and a penalty of rupees 30 lakhs was imposed on them. Friends, Regulation 30, as I said, while it's important for the investor, it is important for the investing public, it is important for every stakeholder of the company to immediately become aware of any material event or information in relation to the company. It is also important to know that non-compliance of strict adherence to Regulation 30 can also lead to very serious consequences and imposition of very severe monetary penalties. I thank you very much. I think we have taken almost 2 hours now, and we have covered almost, I have tried to cover everything on Regulation 30 and related party transactions. Though there may be many more aspects, many more issues that you all may be wanting to know about, but given the paucity of time, we have tried to cover all the important issues relating to related parties and material events. Thank you very much. Over to
Yes,
you.
thank you, Manoj. It was a marathon session, number one. Number two, it was very comprehensive. And as one would have expected, there have been requests for the presentation, which I'm sure you will share with us, because that will only enhance the understanding of this, this entire, both this related party and the disclosure regime. So one thing I must say that the more granular the regulations become, more subjective the queries also become. Now, for instance, there is a statement which you defined, which I have probably come across for the first time, called the absolute value. Now, this absolute value is something I am not aware whether it is finding part in any other context. But then you defined it as if there is positive, negative, then you come out with, I think that is a commonsensical definition. But the way we are becoming more and more litigious and litigation oriented, and also getting into the more into the letter of the law, which is becoming more important. I do not know whether this absolute value, how it is to be ascertained. That is number one. Number two is that I think I'll go by what Mr. Narayana Murthy had said in one of his Infosys balance sheets. Then that when in doubt, comply. So I think in this overall, after hearing for this very, very thorough and extremely well documented presentation, I would only say that whenever there is any doubt arising in the minds of professionals, they should in fact go for a higher level of compliance. Well, that would stand them in good stead whenever things don't happen the way they would probably have. Things would go the wrong way. I am sure that the people who participated would have appreciated, as we have got some requests, and thanks for this, for the very, very detailed and very, very comprehensive presentation, almost covering all the facets of both related parties, transactions, as well as this regulation 30. If there are any questions you would like, we can take it up now. Somebody has already said, amazing session, amazing and such an enlightening session. Sanjay Parab, very informative. So, but an event which is not in, Manoj Kulkarni has asked, an event which is not in ordinary course, does it need disclosure? I think it is too facile a query to be replied, whether it is ordinary or extraordinary. What the regulator wants you is to disclose. So that's the message which one could. And Mr. Rahul Sahasrabuddhe, the person who engaged you in Mulund, he has said, sir, Mr. Bhatia is simply amazing as always. In fact, I got your number from him for engaging with you. It has been a delight, really. And in fact, for people who have lucid and fantastic flow, that is what Mr. Rahul Sahasrabuddhe has commented. Anyone wants to ask? Muted. It is already unmuted. They can ask. So they can also ask. There is something from Pramod Kumar Rai from Nestle. Thank you. It was very informative and intriguing. Arriving at quantitative threshold will continue to be a challenge. So this is, if there are no further questions, then we may close the webinar. But I must say, Manoj, you have made a brilliant presentation today, and most of the queries which people will have in the course of their work, all that they have to do, it's almost like a manual that they have to go through the presentation to find out. And if there are, I don't think there could be any further doubt in the minds of people based on the depth and the range in which you have. Yes, Rahul has said, sir, may I ask a question? Please go ahead.
Hello, Bantyaji. Good afternoon. Yes, sir, my question is, in case of an IBC, initiation of CIRP against a company, your board of directors will be suspended. So in that circumstances, how to analyze whether that suspended board of directors are related party, if there is any further transaction post CIRP. Thank you.
See, if post CIRP, the management of the company vests in the resolution professional. And if the resolution professional continues to enter into any transaction with a related party of the company, since the entire board is suspended, the question of there being any committee, there been any approval, there been any shareholders approval doesn't arise in any of these cases. And the entire management is with a person who is supposed to have no related parties within the organization at all. He is an independent resolution professional with no related parties as such. So though the transaction is with a company which was a related party when the company was not in CIRP, it will not require any compliance because there is no mechanism of compliance existent at that point in time in the absence of any board, in the absence of any committee functioning at the relevant point.
Thank you, sir.
Any other questions?
Right.